So I want to welcome everybody, especially everybody online. So thank you. As you just heard, this meeting is being recorded by video, so keep that in mind. And then the next thing, Savannah, can you help me and do a roll call?
Absolutely. Thank you, Mr. Chair. Good morning to you and members of the board. Jack Prothero,
Here.
Cindy Youngkin. She's
Here.
online,
Okay.
but she's not back yet. That's okay. Porter Bennett,
Here.
Tim Kober,
Here.
Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
and Dan Trost
He's here, but
He's here, but he's wandering.
to be here. All right. There are no legislative liaisons appointed yet, but we do have all 8 appointed voting members present, forming a quorum. Thank you so much.
Okay,
Sorry,
thank you.
Cindy's here too.
Yeah, Cindy's there. We can see you, Cindy. Thank you. So the next thing on our agenda is approval of the February 22nd. No, because they might have some.
Yeah, okay.
Okay.
It's kind of required.
Oh, all right, Mark, if you're gonna be a stickler. So I guess I'll call for public comment with, on any issues within the board's jurisdiction. Hearing and seeing none, we'll go on. And so now I'll call for approval of the February 22nd board meeting minutes. You've all had a copy of that in your packet. Is there any questions or comments or corrections? If not, I'd call for a motion to approve those.
I'll move the minutes.
Thank you, Mark. And Porter was second. Again, we'll call for a vote. All those in favor of approval of the minutes, say aye.
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 Any opposed? Hearing none, the approval is unanimous. We have some administrative businesses that was connected today, our committees. So I'd ask the committee chairs to do a little report. So the first one, Jeff, you're up with the audit committee. Or Mark, excuse me.
Okay. Audit committee met this morning. All members were present. There were no decisions to bring before the full board. What we covered was the legislative audit committee meeting to go through our June 30th, 2022 audit reports is scheduled, tentatively scheduled now for June 8th and 9th of this year. The SOC audit is scheduled, that's with Wipfli, is scheduled for walkthroughs in June, and then testing will occur in July. And the board staff are working with Wipfli, the consultant, on reviewing for the SOC audit on the internal control section of the report. All ethics statements are completed by both board members and board employees. The board reported to the TRS board on February 24th of this year. That's required in law. The board has been updating both the COOP plan, that's the continuity of operations plan, and the internal controls, which the board members will rely on the SOC audit completed by Wipfli for assurance over the adequacy of those controls. The board members have also been sending out STIP confirmation letters. The purpose of these STIP confirmation letters are to get confirmation of who's authorized to conduct STIP orders and that sort of thing with the participants. There's 182 local governing bodies or local government accounts, and another 350 state agency STIP accounts. So those STIP confirmations have been sent out as a security to confirm the authority for those accounts. The staff also did update the audit checklist to ensure that the requirements of and responsibilities of the audit committee were in line with what we have approved as far as the audit charter. With that, we close the meeting.
Okay. Thank you, Mark. That was a complete report. Any questions for Mark on the audit committee? Hearing none, now I guess, Jeff, it's your turn. Loan committee.
The loan committee met this morning. All members were present. We reviewed 2 intercap loan requests for approval, both from the Department of Natural Resources and Conservation. Both requests were approved. Discussions were made by the executive director regarding various potential legislative programs under review. Following those discussions, the committee adjourned.
Okay. Thank you. Is there any questions of the loan committee? Hearing none, the next one is, of course, Human Resources. Maggie?
The Human Resource Committee met this morning and all members were present. Executive Director updated us on the new hires and changes in staff. They've hired a fixed income analyst, Willie Gross. He starts May 8th, I think. They posted for 1 accountant, but they may potentially have 2 positions that they can fill if they get good candidates. They had a failed search previously, correct? They hired 1 intern. Is that an investment intern? That's the one question I had. Okay. They also hired 2 facility interns that will work with an outside entity who will direct their work and assignments on our properties. And then the staff reviewed Executive Director Villa's exempt staff recommendations for pay increases, and a decision will be made at the May meeting.
Anything else? Okay, any questions for the HR committee? Okay, thank you, Maggie. The next thing is we always hear from our pension board members. So who wants to go first? You want to go since you're
I
on?
mean, who's the other pension board person?
Dan.
I'll go first. No, just kidding. Just kidding.
See, it's
Dan.
not just me.
Yeah, you got to go first last meeting because I wasn't here. Okay? I have nothing to report, basically. We met we had an audit committee meeting on February 8th, and I think it's important that we all hear these things, that we had 10 entities that he audited that had no findings, which is great. But sadly, we had 15 who had findings, 1 or more findings. And those findings are generally things like report the wrong hours, don't report any hours. The biggest problem we have in these audits is where they don't offer part-time employees the option of becoming members of PERS. And if they don't offer them that when they're hired and later on they become permanent, those individuals can come back at us and say, I want the money from before. You never offered me the option. So if we offer them the option, they choose not to be part of it and then later become eligible to be participating members. Then we've done our due diligence and we don't have to come up with, or the employer doesn't have to come up with funds. So anyhow, at the board meeting, it was a very brief board meeting. We had some updates to some of our notices. We adopted some MAR notices and had an update from Executive Director Schwinden on the legislative session. And of course, we had a closed meeting, which I can't discuss. So. That's it, kids.
I just, in general, you seem happy with what's happening in the legislature. I don't know, happy is the right word, but I mean, is things going okay?
Yeah, things are going okay. We have a couple that we're following fairly closely that Executive Director Villa's well aware of. So, yeah, I think there's only a couple bills that we're a little nervous about.
Thank you.
And we've done our due diligence and reported those entities those plans that don't meet the 30-year funding, which is by statute, we have to report it. Doesn't mean the legislature is going to help us fund it, not necessarily. So I know they're looking at some of those things, but we don't have a final outcome yet. Hopefully at the next meeting, I'll be able to report on some of those.
Good. Anything else? Dan?
Yeah, we had a very brief meeting, which things are going pretty well. We didn't have a whole lot to talk about. I'm on the legislative committee for TRS, and we have a couple of bills we're following too. I think Sean's been a informational witness on at least 2 bills that we've talked about. And then we have our own bills that one of them kind of sailed through our record or our update bill that we put in every year. And then we also are required to put a bill forth that will allow the Montana University system to fulfill their entire liability. And that goes nowhere every single year. And it went nowhere again this year.
Record pace, though, you guys are getting better.
Yeah.
The same day it was heard.
So when you're talking their liability, you're talking because they went to TIA, correct?
Yeah, they did. And so there's an unfunded liability, and they kick in a certain amount every year. It's small. It's not nearly enough to cover the unfunded liability. So every year it gets worse. And so we put out the dollar amount they would have to do as a lump sum, or the percentage they would have to do ongoing to help that end in the same amount of time, I guess, where we would amortize. We do it. We give them different options, but it's a lot. And it's kind of a good example of what killing off a defined benefit plan looks like, because it's expensive. So, I mean, in some ways, it'd be like, well, this is never going to happen. Why do we do this every year? Well, I think we're required by statute to bring it forth every year. But it's like, well, let's just keep bringing it forward so everybody has a good reminder of what happens when you try to kill off a system that is not fully funded. I think you were there, right? So you gave a review of the Board of Investments to us. It went really well. Dan did a very nice job. And I would mention that Sean would like to see better returns. So that's directed to him.
Oh, that's Sean. So Dan, back to your unfunded liability on the university system side. That was projected to sunset in
2032?
initially, I think it was like 2024 maybe. I'm not sure, but it just keeps going further out there because
Yeah.
it's never ending. It's like the rest of our unfunded
The
liability.
one thing that we found out that's good news is that sunset date does not relieve them of their responsibility to keep paying the small amount they are. So we were kind of worried that, they're going to stop paying on that date. No, they have to pay forever unless something changes. So at least we have that, but it's still not enough.
Okay, any questions for Dan? Thank you. Anything else on tab 1? I think we've got it covered. There is no legislative liaisons yet. Probably won't hear
Probably May.
nay. And then let's see there. So next thing is tab 2, executive director's report. Dan?
We have a snapshot, maybe just a few quick legislative updates. Likely to have a couple of new investment policy statements for you in May. The End of Watch Trust, which is a trust fund at the Department of Justice to pay healthcare benefits for deceased law enforcement officials survivors. Looks like it's going to pass, so that'll be a separate account. There's a constitutional referendum on a mental health trust, $50 million. Should the voters pass that, that would be another separate account within TFIP. We are talking with the Department of Environmental Quality. We do our annual reviews of investment policy statements now into May. Reached out to them to see if we think there's some additional yield we could get them in their 2 Zortman trusts. Right now they're totally STIP. We're going to see if we can split that a little bit, get them into some trust for some longer term benefit. Not that STIP's a bad bet right now, but longer term, getting them into trust would be helpful. Pensions, something's going to happen. I don't know what. I would anticipate some additional contributions into the PERS system, whether that's 0.5% from the employer or 0.1%, I don't know. But it looks like there's some momentum behind some additional contributions. I think the payoff, so the PERS board, I think, proposed something, and the governor's office came in with a lump sum as part of the executive budget to pay off all the unfunded liabilities from the surplus for the public safety systems. That got caught up in the morass of layered amortization and DBDC stuff. So I have no idea what's gonna happen with that one, but I would bet there's either a large lump sum contribution or some form of additional ongoing employer contribution to square those up. More to come. And then the biggest thing for us is it's going to be a very busy, I'd say 6 to 8 months on cash flows as this surplus gets spent. So you'll have all of the tax rebates going out the door starting in July, income tax rebates, property tax rebates following shortly thereafter. Pay plan will have the $1,000 bonuses going out for 25,000 people in the next week. So there's a $25 million lump sum out the door. So STIP, fixed income, myself accounting, trying to stay on top of the bills that are passing, how they're going to impact cash flows, because it's going to get pretty choppy here for a while, but we're not unprepared, I'll say.
How about cash flows as far as some of the federal programs that are being spent down to?
They're being spent down, not as quickly. We did have to separate all of the ARPA money out. So the debt-free bill passed. We kind of had to lead D of A, Budget Office, DNRC, Bond Council. We're all looping together, talking past each other. Finally got all that squared away. We will do our piece of that at the end of the fiscal year. So federal law doesn't allow ARPA interest or principal to be used to pay off debt, which by lumping it into the treasurer's account, the interest would be used to pay off debt. So we have to separate that out. Got them their own STIP account, got them their own Savers account. They're off the books. We're just gonna do, rather than go back and do a bunch of correcting entries for the whole year, we're gonna do one cleanup at fiscal year end and just be done with it. So there's not a bunch of different touches. Gets to the same place, it's just a little bit cleaner. But yes, those are spending down. I don't know that they'll be totally spent by fiscal year end, but from our perspective, the one piece we have to worry about will be taken care of.
Good.
And other than that, you have the memo regarding benchmarks in front of you. We have the rest of the day to discuss, or you can ask us questions at lunch if you'd like. But this is part of our annual report to you of the benchmarks we use, how we arrive at them, and how they're used. So happy to answer any questions you may have on them.
I guess I just want to mention to the newer board members that we have spent quite a bit of time on these benchmarks, because it does help us determine for sure how we're performing. There is a lot of them that have issues. And Becky would probably want to talk about private equity benchmarks for an hour or two. But,
I would.
but anyway, I just want you to know that even though they're there and we're not spending a lot of time on those today, that we have in the past. And I think they're fairly as well as we can do. But I would like Becky, you to actually comment on those benchmarks,
Sure.
What you see, and if you think we're on the right track there. So
Right now?
Right
Okay.
now.
No, in preparing for this meeting and just thinking broadly about benchmarking issues out there in the marketplace, the most difficulty that plans run into is benchmarking illiquid asset classes and trying to find a way to measure how their private equity, for example, is really performing. And there isn't any perfect private equity benchmark out there. So plans, and I'm just using this as an example, will look at small cap equity, which is something we're doing here. They'll look at some other private equity measures that are available late in a reporting cycle. They will look at just large cap equity and add an additional expected return on top because you're taking more risk than just investing in public equities. But what we've done here, we think, is a good marriage of being able to look at returns, look at the asset class that's most similar in every case, and use that benchmark, knowing that it's not going to be perfect. Another example that's actually a little better match is in the real estate portfolio. We have a comparison to a private real estate group of funds that we can compare ourselves to. So it works for a good degree of our real estate portfolio to compare it to other core real estate investments. So those are just examples of, we feel that you are completing and you're following best practices in benchmarking, especially in those areas that there's a lot of debate and difficulty in trying to find a better match. And there are some plans that have kind of given up, if you will. And this started in the endowment and foundation world, where they decided that if there is no private equity benchmark, we're not actually going to benchmark it. We're just going to say the return is what the return is, and is it high enough? And do we feel good about it net of fees? You know, for a group of trustees, that's an awfully difficult conclusion to come to. And it is what it is conclusion, but there are some plans that do that. And when they're calculating their total fund return and reflecting a benchmark for a component of it that matches their private equity portfolio, they just insert the actual return of their private equity portfolio as the benchmark. So that is one way of handling or not handling it. But we think, and we can talk more after John's presentation with more specific reactions. But overall, we feel like the benchmarks you're using are absolutely appropriate in the liquid asset classes, and in the illiquid asset classes, you're using industry best practices to compare those portfolios.
Any questions for Becky? And you know, as we do the policies as a general rule, those are always in there. So anything else, John, on those?
No, when we saw the memo, I agree with everything Becky said. And I guess the only other piece I might add is that, you know, when we think about the pensions in particular, which is where a lot of these illiquid asset classes are, at the end of the day, the actuarial hurdle is our benchmark, you know, so that's really what we're focused on, probably more than, you know, these benchmarks. And Becky noted there's issues with them. And I guess I would just say, and we can, you know, get into the weeds at lunch if you want to, but it's an interesting data point, I guess, if you will, to compare ourselves to the benchmark. But as staff, there are many, many other data points that we're looking at to ensure that we feel good about, you know, individual managers, the portfolio as a whole. And so, you know, the benchmark is sort of, the high level benchmark is sort of one metric that the board sees, but rest assured there's a lot more going on underneath the surface there as well to determine whether or not we think that there's a good investment there or a bad investment, and how we might react.
Any questions on benchmarks? If not, Dan, do you have anything else?
Happy to answer any questions, otherwise, no.
Okay, so I guess we'll adjourn for lunch now, and we'll start the meeting right at 1 o'clock.
Cindy, do you want us to FedEx you a sandwich and some soup, or? You're on mute.
Welcome back. Hope everybody had a good lunch. And we'll continue the board meeting here. We're on tab 3, capital market assumptions, and I think that's Becky, so.
Yes.
And so I'll turn it over to you guys and see if you can educate us.
All right. Thank you so much. And Jim Boyko, our colleague, is on the screen, so he may come in with a comment from time to time. I think if he's not on there now, he will be on there soon.
Oh,
So
good.
he's calling in from New York. But thanks for the time. We wanted to have a discussion about an activity we go through every year, which is trying to look ahead in the capital markets and make some assumptions about what we will think will happen in the long term. And why do we do this? Because you actually look at the structure of all your plans on an annual basis to see if there are any adjustments that should be made based on the long-term view of anticipated market behavior. So this is, as you can imagine, pardon me, it is a really challenging process to take a look at the entire data for every asset class that we cover in research and try to look forward, especially in times like we're in right now. So we're going to take you through how we do this and a little bit about what the output looks like today, but feel free to interrupt us with any questions. There aren't any decisions today. This is entirely educational. And we'll talk a little bit about how we use these, but the high-level summary is that in August, we'll meet with your staff. They're going to come join us in Portland, and we're going to have a meeting to look at the asset allocation for all of your funds and actually look at things that could be or may be opportunities in terms of asset allocation targets. But it's always with the long term in mind. And then John will take that and consider where the allowed ranges should go from there, because that's how your funds are managed, are within a range of how much equity you can have, how much fixed income you could have, et cetera. And he'll look at whether there's any decision points he wants to bring to you for changes in those ranges.
Those discussions, you're using this as a basis for those
Mhm.
discussions, okay?
Right. But there's also other market indications out there of how others have come up with the same kinds of numbers, and we'll look at whether there's any significant differences or not.
Okay.
So with that, on the first page of the materials, I mentioned that we'll be conducting an asset allocation study later in the year, and mentioned the staff meeting that we'll have. One of the inputs into those studies, and these studies are based on a mathematical model, but we don't just take the output from that model because the inputs are really important. We've heard that term garbage in, garbage out type of reference. The same can be true for asset allocation studies. So one of the important sets of input into the model as you think about running asset allocation studies, it's very important to understand what kind of funds you're looking to structure. If you're looking at an insurance pool versus a retirement plan, you're looking at different needs for those two pools of assets. So that's an important input into the process. Also, many times there's some constraints, some asset classes that you've chosen not to participate in or can't participate in. We have to set what kind of minimums and maximums are going to be included. For example, if you're looking at a pension plan that has a very long-term life, you don't want to start with a model that allows you to put everything in cash, because we know that that's not going to be likely the best way to meet the long-term growth needs for the assets and to meet liability payments over time. So you have to put some constraints. Another example of a constraint is you wouldn't want to allow it to go up to 100% in private equity because we need liquidity to actually pay benefits. So we do put some parameters around these studies, and those are really important. We also need to look at, do plans have a return goal, like your actuarial hurdle for the pension plans? Other investors also have investment hurdles. An endowment and foundation may want to spend 5% and then also grow above the level of inflation. So a blended return goal for them would be the combination of those two things. So you've got to have that in mind. You also need to have in mind what kind of risk tolerance the assets should have, or that the fiduciary body has. It's not reasonable to say, I just don't want to lose money. We know in the pursuit of long-term returns that there is the chance you're going to have negative returns like 2022 calendar year proved out. But it's important to understand what kind of tolerance you have for down markets and consider investment structure with that in mind. And then liquidity. You are here to pay benefits for the pension plans. The insurance pool obviously is creating capital to meet obligations. So liquidity requirements are also very important. So every year, we actually get together as an entire firm and talk about the markets in a process that includes all of our consultants and our research professionals. And it's something that we have a certain process we go through, a lot of research that we do and data that we present this group with before we ask them to make decisions on that. But we do this once a year with few exceptions. In 2022, we actually got together twice to see if there was any reason to come out with a revised set of assumptions because the markets change so much in the course of the year. But generally, you can think about this as an annual process. And typically, we don't see a lot of change year to year in our assumptions, but last year was an exception, as Paige will go through. We made a lot of changes to our long-term assumptions because the world changed in a lot of ways. Interest rates went up a lot. Equity prices corrected, and the inflation picture changed a lot last year as well. So as we look forward on page 4, just a couple of philosophical points to keep in mind. Our forecast horizon is long-term. We define that as 10 years or more. A lot of cases, we're really talking about 20 years or more. We do look at expected return for every asset class, the expected risk, which is defined here as how much returns move around. It isn't just the chance of losing money, it's actual volatility in the return stream. And then we have to look at the relationship of asset classes one to another to see if there are opportunities for diversification. So another couple things to keep in mind is we're not trying to, in this process, build in how much we think managers will outperform their indexes, because that is a structure decision that you make here. You have to decide within each asset class, how much do we just want to index, like domestic equity here, versus have active managers. So this is a baseline set of assumptions that does not include managers beating their benchmarks. They're just meant to express how we think the markets will behave over a long period of time. So what does it mean to get returns right? That on the next page, page 5. We're looking at, of course, absolute accuracy. It would be nice to be able to show you a track record where we got the equity return assumption right up year after year. And almost by definition, you're never going to get it precisely right. Over a long period of time, what we're really looking to do is to provide a set of return assumptions that allow you to build a diversified portfolio and get the relative relationships right. We think over the long term, equities will outperform fixed income. And there's a lot of different types of equities and fixed income that we look at, but we're looking at the relationships among asset classes that we're trying to get right as well. First chart here for you on page 6, this is actually a little historic perspective on expected returns. We've actually at the top portion of this chart shown you the historical range of actual 20-year returns for every asset class, and then we superimpose in the dot where our long-term return expectations are today. And one of the things you can take away is that while large to mid-cap US equities have had a huge range of returns over a long period of time. So again, any one year is going to be very different than the long term, we believe. And as we make return expectations, that's going to be true. At the bottom of this page, we actually superimpose 2023. So that's the return set we're going to be talking about today with you. 2023 expected returns versus the historical range of expected returns. So this is showing where we are relative to where our assumed returns have been in the past. And if we look at this chart last year, for example, because we've been through a period of such strong equity returns, you would have seen that our expected returns were more towards the left end of these bars, showing a more modest expected return going forward. But now with some of the corrections that we went through last year, we think that the prices of many asset classes look a lot more attractive than they did. And going in price is very important in your actual experience return. So we think going forward, we're feeling a little bit more rosy about many asset classes because of many things, And we'll go through some of those elements a little later in the presentation.
So this question, these are 20-year rolling averages from when the stock market started, or what's our time frame on these?
So are you looking at the bottom?
I was still looking at the top one, but yeah.
This is actually looking at a 20-year rolling period. So you're right. That's in the fine footprint at the bottom, starting from January of 26 in the case of the S&P. So it's looking at the history of these asset classes, and some of them don't have as long a history as the S&P. Great question. On page 7, we've got a different picture, and here we've actually got our return expectation for these asset classes versus how much uncertainty we're expecting. And if you remember statistics classes in college, or whether you tried to block your memory of statistics classes in college, what this is trying to capture is about 2/3 of all possible markets. That's what we call, or we classify as one standard deviation. So it's trying to capture the bulk of your market experience, knowing that you're going to have some markets that are so much worse and so much better than this. But this captures a good deal of them, and you can see that that expected return has a lot of variation left and right, especially for more risky asset classes. In fact, this is a way to pictorially think about risk defined as a return volatility. Look at how broad that emerging market line is, where the uncertainty of returns as we've built into our model could show that 2/3 of all markets could actually range from a loss of about 15% to a gain of about 37%. So we are building in risk into these models, and this helps you pictorially get a flavor for how much risk we are building in. Look at the relative difference between the width of the bars in blue, which are different kinds of equity, and green, which is different types of fixed income. And one thing you should take away is that the return variation in fixed income is a whole lot less than equity. And that has been shown to be true through history. If we look at other types of investments, core real estate, it's got a variation that looks a little bit more than fixed income. And if you look at private equity, you can see that it is an equity at the end of the day, and you would expect it to have a broad array of return volatility, from very negative to very positive. So pictorially, this is how you can think about risk as we model it in our asset allocation activity. Any questions to this point? We're going to keep building on these concepts, so we'll keep using some of this terminology as we go through the presentation. Paige is going to take us through a high-level view of our return assumptions that resulted from this process.
Hello, everyone. Thanks for having us today. So I'm starting on page 8 of the presentation here. It's titled Themes for 2023 Capital Market Assumptions. So just a few high-level themes, I think, to keep in mind before we dive into what these actual updated assumptions look like. The first of those building blocks being inflation, a factor that we look at. We did not change our inflation assumption this year. That is remaining steady at 2.5%. To address that might be confusing to some people who have been following the inflation news and feeling the personal impact of that on their wallets. I think it's important to keep in mind when we're looking at any of these assumptions that we're dealing with a very long-term forward-looking data set. So as Becky mentioned, we don't put a specific time frame on it, but to ballpark 10 to 20 years looking forward into the future. While it's true that we are in an extreme inflationary environment at the moment, we're also factoring in the impact of what happens when we come out of this current inflationary environment. So let's say, again, don't have a crystal ball, but if we were to enter into some kind of recession, there could be some deflationary impacts that we see in the economy. So when we're projecting far into the future, we need to account both for the current state of inflation and also where we think it's going to go moving forward. So that's the explanation for why we've left that assumption unchanged at this point in time. Another thing that we look at when we're building up all of these assumptions, mean reversion is one of the big things that we keep in mind. So the idea being that over the long term, asset classes should always come back to their long-term mean for that return. So if you take a year like 2022 as an example, we saw broadly negative returns across asset classes. So that is going to have the impact of bringing down the mean or the average, if you can think of it that way, return for these asset classes. So theoretically, there's a little more space within that asset class to have a higher expected return potential in the future. So you'll see that impact come through for the individual asset class returns. We do see a net positive effect for most of these forward-looking returns, and that's a factor of the mean reversion that goes into the model that we're building for each of these. The last point here being increased yields. So specifically, if you look at the fixed income side, we're obviously been in an environment where the Treasury yield curve has come up significantly over the past year. So while that has had some painful effects on fixed income markets in the interim, the overall impact is that we're actually seeing yields return to fixed income. You know, we're not sitting at this 0 to 2% rate. We're actually seeing some real positive income that can come back in the fixed income asset class. So again, that pulls into the build-up model that we have for creating these asset class assumptions. So flipping forward to page 9, this graphic actually compares our assumptions for 2023. We also provide 2022 as a data point so you can see what has changed over the past year. So Becky and I were just joking, we sometimes get to provide good news to you. You can see green over on the far right-hand side of this page in the column that says change. So that is comparing the 2023 assumptions to 2022. You can see that broadly speaking, most of our asset class assumptions have increased since last year. And by a pretty good margin, you know, again, where we're looking far into the future, but for an equity return assumption to increase from 1 to 2% is not a small impact on your portfolio. Becky's going to go into more details for the changes for each of these asset classes specifically, but just to give you a high level flavor, every single equity assumption that we have increased since last year. Every single fixed income assumption that we have has increased since last year. The small bit of red that you do see on the page here is within real estate. And again, I'm going to leave that to Becky to touch on what drove that there. But that, you know, for only 2 underlying asset classes to see decreases is just overall really positive news. And you'll see that positive news flow through into your forward-looking expected returns when we do the modeling later this year. Are there any questions I can answer on data or any asset classes you're curious about covering right now before I move forward? Sure.
I always think in my mind when we talk about return, almost in the same sentence, you always got a return versus risk. Because I think they can't be talked about individually. So could you talk about that when we're looking at some of these returns? Can you complete the rest of the sentence and talk about risk?
Absolutely. So we do have risk included on this page. So it's going to be the column directly to the right of that nominal return or arithmetic. Again, just to focus on, I'm going to focus on the changes because I think that's, you know, what we just talked about with the returns. You will see minimal changes to the risks that are shown here. You know, that's really just more of a function of the modeling that is in place for these asset classes. When we're looking at something like risk, which we're proxying with standard deviation, that doesn't tend to change a ton year over year. And this is actually something we evaluated several years ago in the context of our capital markets process. Just are we handling risk appropriately? And we made some updates to the modeling here to make sure that we're not kind of knee-jerking when there is a volatile year. So
you can think about that chart that I went over that showed how wide the blue bands were for U.S. equity and where the current expected return was sitting within those bands. What Paige is reflecting on is we didn't change the width of that range of possible returns in equities or fixed income we felt that it was wide enough and represented the possible return volatility of that asset class. So there weren't any relationships that we felt needed to change a return versus risk broadly as you look at this assumption set. But you're right. And in fact, if you want to get really technical, the nominal return that is just to the right again of the standard deviation number that Paige pointed you to on this chart is actually the expected return we set, but it actually takes into account the path of returns for that asset class. And so risk is affecting it. And by the time your US equity large cap investment at an assumed return of 6.75 actually goes through a number of actual cycles, we think the actual experience return will be something more like 5.6 because it does have risk. And it will go down, it will go up, but over time, risk does erode that return a little bit. So that's another thing you can look at in this chart. And our mathematical model that we'll pour all these numbers into is actually going to take into account the effective risk on that assumed return in the process of calculating potential portfolios.
Yeah, this is Jim, if I could chime in. That GEO number, you see it in at the far right-hand column, you see the parentheses at the top of it called GEO. That essentially is, as Becky said, that's the return that then is penalized, the long-term return, which is then penalized by how volatile it actually is. So the more volatility, the bigger the penalty. Volatility is the enemy of long-term compound returns. Compound is another word for geometric. And so, so it's an excellent question, and it would not be wise or would not be competent to have a set of capital market assumptions that didn't have that geometric or compound return with the penalty, the volatility penalty built into it. The only other thing I would add is that there is a mitigator as well that that is the third leg of the inputs, and that is correlation. And so the more persistently and regularly an asset class is uncorrelated with others, particularly equity, the more valuable it is in terms of mitigating the total funds risk. One of the unusual features of 2022 is that it was an unusual year in that the fixed income, which typically has at least no correlation or a negative correlation with equity, had a positive correlation. So they both went down at the same time. That's highly unusual. So, but that's not something that we expect to be normal, or we would change our outlook. So I'll stop there.
Well, Jim, I just want to comment, thanks for putting on a tie for us.
Oh, I'm sorry. I'm on the road. I'm doing the best I can.
He has a vest on.
Yeah. I'm going Montana here.
So if I understand what you're saying, you haven't really changed your risk assessment.
Not this time, yeah.
So everything is being driven by the return to give us a better picture than we were looking at last year.
And we're going to show you a picture that makes it even more obvious here in a second.
Okay, I hope you do.
Yeah.
Okay, so I'm going to move forward to page 10 here, titled RVK 2023 Expected Geometric Returns. As Jim was just referencing, that's the GEO abbreviation we just saw. So these are the forward-looking return assumptions that are taking into account the volatility or that risk assumption associated with each of these asset classes. So I think it's just a good thought exercise, right, for any plan to go through thinking about. You have this return assumption that you're trying to hit. So for both PERS and TRS, that's 7.3%, the rate set by your actuary. It would be potentially enticing, right, to look at these asset classes and say, okay, well, we're trying to hit 7.3%. Why don't we just pick these asset classes that we know are going to get us there? So if you just had a return target to deal with, you know, potentially you could do that. Unfortunately, we're not just dealing with a return target here. You also have obligations that you have to pay. So you cannot afford to go all in on an asset class that could lose you a ton of money necessarily. So if you look at the highest returning forward-looking return assumption here, that's emerging markets equity with a forward-looking return assumption of 8.5%. I can also tell you that, other than maybe private equity, emerging markets equity has the second highest volatility or risk associated with it. So that is also a factor that we need to keep in mind when we're looking at these asset class assumptions, with correlation, as Jim mentioned, also being the third factor that we're looking at when we're building these portfolios. So the asset allocation exercise in and of itself really needs to encompass all three of those factors, with the goal of ultimately building you a portfolio with the best chance of achieving that return target that you're trying to hit, also with the best chance of minimizing your drawdown risk associated with that portfolio. And while building that portfolio, hopefully we're able to pull in a wide range of asset classes that introduce correlation benefits to the portfolio. And we have a slide in a few slides here that will look at correlation specifically in a little more detail. So
here's the page that I was talking about.
So I'm on page 11 now, titled Capital Market Line. So the capital markets line is a visual representation of the trade-off between risk and return for each of these individual asset classes. So on the x-axis here, we have a standard deviation, which is representing risk. On the y-axis, we have return, representing that forward-looking return. And you're able to see in a really nice user-friendly way, where does each of these asset classes fall on that spectrum between those two factors. So the blue line on this page represents the capital markets line for this year, for 2023. The dotted yellow line below that, you can see, represents the capital market line for 2022. The main difference that you'll see between these two lines here is that there's been an upward shift in the capital markets line since this time last year. And that means that for the same set of asset classes, you have an increased return potential with really, I don't want to say no, because there is a little shift over there, but with very minimal increase in risk for the same set of portfolios. So that is good news for these asset classes, and that is good news for your portfolio. When we go through the process of updating your asset allocation on a forward-looking basis, without any changes on the margin, we expect to see that your forward-looking expected return is going to increase with very little increase in the risk for the portfolio as well.
Okay, help me understand this. So, okay, got the standard deviation, but these points here that are on here, that's your selected returns for these asset classes currently.
That's correct.
Okay, so I don't know if it answers my question, because you already said, okay, we're assuming a better return going forward than we did last year. And this is just a graphic that's helps support that, because you're using your assumption on return. So I don't see how okay, well, where did you get the return assumptions?
So
why is that being brought up?
we're going to go through examples of why those were brought up by looking at some major asset classes, so you can see why. One example is in the equity world, dividends are higher. And so that's one thing that's part of the return stream that is higher. So we're projecting that is going to help returns over the long term. That's just an example. Or fixed income yields, interest rates are higher, and that's the primary source of return in fixed income. So that helps us, again, look forward and say we think fixed income is going to have a better return, since most of the return is really dependent on that interest rate, on that coupon. And the way you can think about this is the dotted yellow line. We didn't show you all the little dots that go with the dotted yellow line, because that is the line that fit the array of expected return and risk for the asset classes last year. Now, we've moved to the blue line. And so you could see for every point in standard deviation, you can move from the yellow line to the blue line and get a little better return, because you're moving up. And we did show you all the different asset classes and where their individual attributes were that the blue line generally fits through. So the yellow versus blue line is where you can look at this and say, gosh, with this expected set of long-term returns and expected risk, we believe it's a better opportunity set than it was last year.
And
we'll
largely
go
that is simply because things are cheaper now. I mean, it's unfortunate, but 2022 left us with cheaper investment opportunities than existed a year ago. The only other thing I would say is, and Becky is absolutely correct, each one of these dots that you asked about that has a return assumption, there's a whole lot of math behind, and that's unique behind each one of those. But the one thing I did want to make sure that we drove home is that this kind of analysis, in fact, all kinds of analysis, say almost nothing about what happens in the next 12 months. If there were good methods for making short-term market predictions, the individuals or firms that had that would be incredibly wealthy, but there isn't. 40 years of market history has proven that 6 ways from Sunday. So this is strategic in nature, and it just simply means that the multi-year outcome looks more promising because things are cheaper now than they were. Unfortunately, but you have to, the fact is that is a positive if you're investing new money or retaining existing investment exposure. So I'll stop there.
Any more questions? We'll keep building on these same concepts. Yeah.
Can I just go back a page to page 10? So as we look at that chart,
Yeah.
there's 4 asset classes that, in your estimation, will meet our expected return. Should we be concerned? Is there a way to build a portfolio that can meet our risk tolerance and meet our expected return? I mean, is that where we're getting to here?
What we're getting to, and we can't get there by only combining those 4 blue asset classes, because the risk would be so big that the drawdowns would be incredibly painful.
But in the absence of alpha or, I guess, good tactical investment decisions, it would be very difficult to create a portfolio, a balanced portfolio that would hit 7.3 based on these future assumptions. Is that fair?
It is fair, although, the addition of having some asset classes that you'd look at private equity and see how much more it's returned over the long term, and other areas where you have active management have been very accretive. And this is an exercise we update every single year. So you can't necessarily just plan the next 30 years by just looking at 1 year's set of assumptions or 1 refresh of that long-term environment. But what we found is that you can combine these asset classes and control risk and be very productive in trying to generate that return over time. Part of the challenge in building portfolios and part of the goals a lot of times is win without losing as much. Plans that actually try to do better in down markets while combining it with the desire to grow tend to actually build assets more effectively over time. And that's another set of testing that we actually do, looking at down market scenarios, and we can actually show that. If you have a portfolio that has a great expected return and was formed without regard to risk, say like combining those 4 blue asset classes on the left-hand side of this chart, you may lose so much in a down market that you're going to get a much poorer return over a 20-year time frame relative to one that has fixed income, that has real estate, that has other asset classes that helps the portfolio do better more consistently and not lose as much in any 1 year.
And if you think it was tough, it's tough under the current circumstances to meet 7.3. Imagine how difficult it was a year ago when valuations were much higher and the prospective returns because of that were much lower. The strategic opportunity for institutional investors has improved modestly, simply because, again, things are cheaper today. But the other thing I would say is that meeting an actuarial assumption, an actuarial target, is not a black or white situation. You either meet it or you don't. In some respects, that's true. But when you're trying to build a portfolio that gets you as close to it as possible, what you're looking at is a distribution of potential outcomes, and you want that distribution to fit over your assumed rate of return quite nicely, with the assumed rate of return being the median return. That is a 50-50 chance that it'll either be above or below. I say 50-50 chance because a distribution is a probability. So even if an asset allocation said, gee, the median return was, say, 6.9%, just to pick a number out of my pocket, that doesn't mean that there is no chance of meeting 7.3. You could make 7.5 over the next 20 years because that's still inside the distribution. It just doesn't have a very high probability. And the probability of meeting your assumed rate of return isn't the ideal 50%. It might be 46%, but it's not zero. So I hope that's helpful.
Yeah, that makes sense.
Mark, I've been sitting here trying to think of a better way to answer your question, and I'm going to take a stab at it, and I'll let Jim opine on where I go wrong here. But I think I don't think I explained this very well to Leighton. So I think that the major difference between how we build up our return assumptions and we build our risk assumptions on an annual basis is that the return assumptions do tend to be more of a point in time evaluation. While they are long-term forward-looking, something like the return is much more sensitive in a mean reversion setting to a very big or to a very, largely positive or largely negative year. So we do tend to see larger changes on the margin when we have an extreme market event like we did last year. Whereas something like a risk assumption, when we're proxying with standard deviation, it's really just volatility at the end of the day. So whether it's a big return year, largely positive or largely negative return year, the volatility over the long term for that asset class isn't impacted because we're already capturing the volatility from the entire historical data set that we have for that asset class. So it doesn't mean that we're not looking at the same impact, I guess, looking at the same market over the last year. It just means it just tends to be more captured in that data set. It's less of a qualitative judgment. It's volatility. So I don't know if that helps. That's my best attempt.
Okay, I'll think about that.
Okay.
You can explain that to the rest of us.
Okay, so moving on, page 12, we have talked about correlation a little bit. So this is really the third factor that we're looking at in that framework of asset allocation. So again, being return assumption, risk assumption, and correlation. So correlation is a quantitative measure of the degree to which asset classes move relative to each other. The correlation value itself can range from a +1 to -1. And really, when we're looking at diversification and the correlation numbers themselves, it is true to say that a value of -1 introduces more diversification to the portfolio than a value of 0.9. But at the end of the day, any value that is less than 1 is going to introduce some kind of diversification benefit to the portfolio. So
Any value less than 1, so the red numbers.
So really any number on this page. So I'm going to look at the broad U.S. equity column, the farthest left here, and maybe we can pull out a few examples to illustrate what we're talking about here. So if I'm looking at the matrix and I'm taking the cross point of broad U.S. equity and broad international equity, we can see that the correlation historically for these asset classes has been 0.85. So 0.85 is less than 1. So these asset classes, 85% of the time, move in the same direction. So we would take two asset classes that 85% of the time move in the same direction over two asset classes that 100% of the time move in the same direction. So while we're introducing diversification benefits from those two asset classes, it's not necessarily going to be the highest degree of diversification within the portfolio. To pick another example out of this same column, maybe let's look at, I'm just going to take fixed income because it's the other major asset class. So the cross section of US Ag fixed income with broad US equity, we have a correlation value there of 0.21, which is quite a bit less than 0.85. So essentially that number is saying that around 20% of the time, equity and fixed income returns are going to move in the same direction. We don't have a negative number in that column, but if we took the US Ag fixed income column as an example, we can see several negative values there. And really those negative values, and you can see that it tends to be from those private asset classes. So private credit with a correlation of negative 0.18, private core infrastructure, correlation of negative 0.12, private equity, negative 0.06. So what that means is those asset classes are actually moving in opposite directions. That's what the negative number is going to mean there. So it sounds kind of weird and abstract, but the idea at the end of the day is that we want to pick asset classes that are going to, at different points in times, kind of move in directions like this, kind of a wobbly line there, with the idea being that we're going to smooth out the returns for your portfolio so that you're not experiencing any major really decreases in the value, because as a system that has liabilities that it has to pay out, that's kind of the name of the game. You don't want to be in a position.
So question for you, John. So are you looking at this correlation tape next when you're talking about your portfolio with staff and that sort of thing, and how it's going to?
I mean, not on a daily basis type of a thing, but it's certainly something we consider mostly during, as we're kind of talking about here, like our August meeting to take a look at the asset allocation. Sure, we're definitely thinking about it at those points in time. Yeah.
Awesome. One last slide that I'm going to cover, and then I'm going to turn things back to Becky to go into more detail on building these individual asset class assumptions. So I'm looking at page 13 here, and this is just a summary of the return, the methodology used to build just the expected return for each of these assumptions. So you can see that we actually have 3 different methodologies in place depending on the asset class that we're working to build up, and that is really a function of the research that our capital markets research team has done to evaluate what they think is the best way to build each of these models. So the building block methodology shown at the top is what's used for most of our asset class assumptions. We do also use what we call the spread methodology for both private credit and private equity. And then there's a blend of those different methodologies for things like global tactical asset allocation and diversified inflation strategies. The reason for that is because those encompass multiple different asset classes within each of those sub-asset classes.
So you can think about this, and this will lead into the pages I'm going to cover next, is the asset classes near the top where there's a building block methodology. We're coming up with the expected return by building a layer cake, saying we have a layer that is income, which is dividends and equity. We have inflation that's going to be a layer of that cake, and so you add those together. And then the extent to which there's growth in that company's earnings and equities earnings, that's another layer to the cake. And then whether equities are expensive or cheap could be the icing on the cake, or it could be a section taken out of the cake where it's worth a little bit less. And the spread methodology are typically based on other asset classes, saying that in private equity, they're equities at the end of the day, but really, they're in private form. So we're going to start a return assumption by saying that if it's an equity, how are our equity return assumptions looking in the liquid markets? And then we're going to add some additional return to pay us, in essence, for the fact that they're illiquid, they're private. So that's a spread methodology, is just adding, based on another asset class, adding additional expected return because of, in a lot of cases, illiquidity for private equity.
And you're getting that return premium as you're looking at historical spreads between?
Yes, we are looking at how much private equity has outperformed US equity and learning from that return premium, knowing that there are some cycles when private equity has vastly outperformed the liquid equity market, and other periods when the US equity market has been so strong that the private markets haven't added as much return premium. But we're trying to look over the longest period of time for those differentials when we're setting that. Great question. Shall we look at the cake making a little bit more?
Only if there's cookies outside.
Well, there's candy at each of our places. Maybe that helps, but
Amen, amen.
Jim's hoping or wishing he had cookies in front of him. Let's go ahead and move to page 16. This kind of shows you a layer cake look a little bit. Then I'm going to show you another chart on the next page. This is just one of the models we use to try to create our equity assumptions, and it shows those different layers. For example, if you look at large cap US equity on the left-hand side, again, we use multiple models. This is one where you look at first inflation, which is that orangey color. 2.5% is our expected rate of inflation over the long term. You add to that dividend yields, which is the lighter color of yellow. Add to that how much we think earnings growth is going to be in the future. And so those are 3 layers right there that are primary. But, you know, the degree to which equities are cheap or expensive could take away from that combination of all those factors. And in this case, equities are still expensive in the United States. Even though we had a big haircut, we actually had a negative return on the S&P in 2022 of 18%. They were still very expensive going into that year and are still a bit expensive. In fact, if we look over the whole history of the US equity market, we still rank in like the 89th percentile, meaning that only about 11% of other markets are more expensive than what we've been in. So we're actually going to take a little return off the top of that layer cake because it is expensive. If we look at small cap, kind of similar, the same layers to the cake, but notice that the gray at the bottom is even more negative. Small cap was even more expensive than large cap. So we're going to take away a little bit more of what we expect from future return because of it. Now, another interesting set of charts is the 3 columns to the right for non-US equities. So we have the large cap non-US equity markets. And you'll notice there's another layer. There's now an orange layer, which is currency. Because we do know that they're valued in currencies other than the US dollar, but we have to translate them back into our currency, as you know. And as we look forward, we think that the US dollar has been very strong for quite a long time. And we think that will weaken somewhat as we go forward. That should be additive to returns for all of the non-US equity markets. That orange layer you see is positive and on top. But there's some other things that are a little bit interesting here too. Look at the light yellow layer for the non-US markets. That is dividend yield. Notice that it's larger than the US layers for dividend yield. That's just a reality that tends to get lost when you look at total return, is that the non-US equity markets pay more dividend yield than we do here in our markets. And that is additive to return, we think, going forward. And valuation is the other thing that's different. When we look here at the gray layers, they're not below the line, they're on top. We think because they've been less expensive as we look at the current markets, that going forward, they have the potential to have more return. And it's like anything that you buy. The cheaper price you can buy it going in should help you in your long-term return experience. So again, it's just illustrative of one way of building expected return in equities is that layer cake. For fixed income, it's similar. There's just different layers here. They all start with inflation, then they add, for example, the interest rate environment. So
on the foreign markets, how do you factor in political risk?
that is a big consideration as we think about those markets and the relative volatility of those markets. You'll notice if you look at some of those charts early on in the presentation, our expected risk for international is bigger. And part of it is due to currency is another variable in there. We do find that there are some markets, for example, the emerging markets. When you think about a crisis like the Russian-Ukraine war that started, there are some markets that just get punished even more when there's uncertainty. Investors flock to what they believe are higher quality assets, like US fixed income, or like the Treasury, the US Treasury, and they will sell off emerging market equities because people are concerned about taking risks by investing in some of those markets like Latin America, like emerging Europe, like China and other areas. So part of that consideration is built into looking at the actual return streams for international, but it's also thinking about some of those relationships. Jim, I'm sure you have something you'd like to add.
Yeah, the only thing I would say is that it is not, what we don't do is to say, because I don't think there's any basis for it, oh, the world will be much riskier over the next 20 years than it has been over the last 20 or the last 40. The last 20 and 40 have seen multiple wars, seen bankruptcies in the emerging market world. Venezuela, Turkey, Argentina. There's always, as we look forward, more things that we worry about. But the issue for us would be, can we make a credible case that they are bigger, more important, and more importantly, more likely than the kinds of event risks that have actually taken place and are embedded in the return stream that Becky mentioned. And we're not sure that we or anybody else is that competent that can say there'll be several more Ukrainian wars. They'll happen soon and they'll be bigger, they'll be more costly, they'll hurt the markets more. I don't know that we're in a very good position to make a credible forecast in that area. But as Becky said, we do factor in higher volatility, basically because both currency and event risk historically has been higher in the international markets, and that's a basis for at least having some spread. So I'll stop there.
Let's go ahead and move to the next page. And
One
yes.
question on this.
Sure.
I look at the total estimate, I guess, for returns on each of these asset classes. And I'm thinking back over the last 15 years and reviewing capital markets assumptions from folks that do this work. And it's looked like this the whole time, that international is going to do better than the US. I know that this is now, we're looking forward 10 or 20 years. I guess I'm just wondering if we're going to be looking at a chart that looks just like this 20 years from now and it still didn't happen. It seems like the difference between valuations in the US and international, it's just gone more toward the US over these last 10 or 15 years. So is this time, and I agree, I mean, mean reversion and all in these building blocks make it look like international is the place to be. I guess I'm a little skeptical because I've seen it for so many years in a row.
Yeah, no, it's a great observation. If you think about especially the last 10 to 15 years and look at how accommodative our Fed has been to bail us out of the great financial crisis, and then all of the stimulus that went into our economy to bail us out of the COVID crisis, it's been huge, and it's been bigger than a lot of non-US markets and their central banks. So in a way, it pushed up the US equity markets. Investors looked at that, and number one, they weren't making much money on fixed income because interest rates were so low, and they were looking for places to earn a return. It pushed risk assets up, and the US equity was one of the biggest beneficiaries of that tailwind, if you will. So it is a great observation. We don't know what the future will hold, certainly, but the Fed is a big portion of why our markets have been so resilient. And there's also the perception of the US equity market being one of the markets that investors flood to when they're concerned about the emerging markets, for example. But, at the end of the day, this is one of the things that the constraints on the model that we'll run with staff in our office, and then when John's thinking about his recommendations, we put constraints on the model because we don't want to tilt so far into non-US markets that it puts us at such a big overweight that's completely dependent on these kinds of forecasts, we're going to put constraints by saying we know we should be in US equities. And then we know that it makes sense to have a portion of our equities in non-US markets, but we'll control how much the model can put in it by those constraints. They're a really important part of the process.
Yeah, your earlier question actually goes to the heart of how much weight you should put on what the numbers say. The numbers say, as you point out, that the international markets have been cheaper for some time. Now, there have been periods like 2015 and like last year where they actually outperformed the US market. But over that period, they have fallen noticeably behind. But part of it too is that it is very difficult to take a period like the last 10, 12 years and make judgments at the beginning of that period that, as Becky pointed out, our reaction to COVID and the GFC, particularly COVID, would be 2.5 times what the rest of the world did financially, our monetary and fiscal reaction, which is why, in major part, why we set off inflation. And the other thing that I think will be very important in John's recommendation is you have to pay your benefits in dollars. You can't pay them in yen or in euros. And as Becky said, that means that you may put constraints on how much the numbers tell you might want to have in developed markets, simply because you can't pay with developed market currencies. And to the extent that as you are, you're cash flow negative as a plan, that becomes even more important. So, but that's a judgment issue. The numbers say what the numbers say, but the judgments are important as well. And they're not just guesses, they're informed by the structure of your plan. So I'll stop there.
Thank you.
I think in the interest of time, I'm going to go ahead and skip ahead to looking at fixed income. Since we've talked about the layers of building domestic and international expectations, let's look at fixed income on page 19. As I mentioned, a good deal of the process of building our fixed income return assumptions begins with where are yields today. And the great news that has pushed these numbers up that page reviewed with you, in green, the one-year adjustment in the upper right-hand corner of page 19, just look at the magnitudes of those changes. And it's because the Fed has been so active in moving interest rates up. And then you can see the US aggregate, the nominal return assumption increased by 1.5% as we look forward. That's good news for investors who are looking at ways to earn return going forward. Fixed income was painful for a lot of investors when yields were very low. But now that yields have moved up, all of a sudden, this becomes a much more productive asset for a lot of investors to consider. And that's true across the board for other types of fixed income, like low duration, like long duration, like Treasury inflation protected securities. That's what TIPS stands for, and non-US sovereign fixed income. So one of the reasons why your expected return is going to look better when we run it in the asset allocation in late summer and then bring information in the fall about the changes that John would like to make is that fixed income is going to contribute more than it has in a long time, we believe, to your return potential.
Or John from law school.
Yeah, I know.
Kirsten.
Yeah,
Kirsten's the one killing it.
yeah, exactly.
I think it's just because he's not there anymore. Oh, that could be.
That's true. That's true. And the little chart just to show how impactful it has been. If you look at the relationship between the current yields and the next 10 years of how fixed income is done, there is a very tight relationship where all those colors are coming out. You can put a line right through it and look at the yield that you're going into a period with, and then the next 10 years, it's a tight relationship. And the 2022 trend line is saying that that's about 5%. So again, fixed income, it's mostly about yield. And that, again, is a positive relationship over time. There are other fixed income asset classes on page 20 that we use a spread methodology where we're adding additional expected return, like high yield bonds, below investment grade bonds. We start with what's happening in the yield environment and then add to it for the anticipated risk. They tend to pay higher yields. So we use that same kind of methodology for a number of asset classes. And again, the green in the 1-year adjustment is pretty significant for most of them. And then real estate, Paige had mentioned on a spoiler alert that we actually trimmed our real estate assumption back a little bit, not a lot, 25 basis points. You may say, why? Well, last year, real estate had its best return on record for the index. Prices are expensive as we look at the yield environment today and how properties are valued. We think it's not gonna, we're not expecting a big correction here, but we're not expecting that continuation of high prices. We think it's probably gonna moderate a bit, but this isn't a significant adjustment to the assumed return for real estate. I don't want you to be concerned about it. It's just looking forward and saying that we think that prices will come down a bit there, and actually the income from real estate coming down a bit as well.
But this is a good example that shows that per the question, there's something specific, there's specific analysis behind each one of these return estimates. And that specific analysis is very specific to what's happened and what is happening in that asset class. So while you might be surprised that we're pulling one asset class back just a bit while we're moving the others up, you know, that's a part of our process, and we think it's a healthy part of our process. It turns out, while many people have been unlucky about the current problems that regional banks are facing, it turns out that maybe we got lucky for the wrong reason in this move to slightly curb our real estate estimate, in that there's estimates that 70% of all real estate loans come from regional banks, not from the handful of too big to fail money center banks. And those regional banks are obviously under some pressure to raise their lending standards and curb lending. There's some evidence that just emerged this week that that's happening. That's not a plus for real estate. So, like I said, this is not something we foresaw, but it is something that's happening that happens to be coincident with the direction of our move on this asset class.
The final couple of charts here, private equity, we've talked about a little bit already. It is an asset class where we tend to start with liquid equity markets, the large cap market here in the US, and then add a spread to it. And that spread is a little over 200 basis points, a little over 2%. So we still think that there's a higher expected return to be had here in the private equity markets. And probably the assumption that you would question the most or wonder about the most would be on page 23. And we probably should have put this chart first, because we do build inflation expectations into every asset class as we build the layer cake up. We looked at inflation in so many different models. We looked at how investors are pricing in expectations for inflation through comparing the price of Treasury inflation protected securities, or the yields, and a comparable Treasury. That still is coming in with a very consistent message of about 2.5% inflation over the long term, not next year, not the year after, but in the long-term path of inflation. So even with looking at a lot of different models, we have inflation in front of us. We know, food has certainly been a big area of concern. And now, energy is always an area of focus when we're thinking about inflation. But there are deflationary components in our economy as well that we're looking at. And one of them is, if you look at the little chart there on the left-hand side with the blue line, that is the money supply in our economy. And you could have drawn that line without having any data, just looking at how much money has been pumped into the system in the great financial crisis. And then as we look at more recent periods as well, starting in 2020, certainly a lot of money in the system, but it isn't changing hands as much. The M2, or money velocity, is in the green line. They're heading in opposite directions, which means that that money isn't working in the economy to continue adding to inflation. If anything, it's kind of held back the reins a little bit on inflation. There's a number of things we looked at too in terms of the path to getting to the long-term assumption, how many years it would take to get to 2.5. But at the end of the day, there just wasn't enough evidence that inflation over 10 to 20 years is going to be significantly above 2.5%. So we'll see how successful the Fed is to moving us to that inflationary rate. You saw in the news this morning that the anticipated increase in inflation, if we look month to month, was less than expected. If we looked at the prior month, it was half of what expectations were, although we're going from 0.2% down to 0.1%. But just look at how inflation, since June of last year when inflation was over 9%, and now we're about 6%. It's still way too high, but that is movement in the right direction for sure. So that was, and it has been for many years, one of the biggest sources of debate in the firm is what should we do with inflation? So with that, just a couple of reminders. We've gone through a lot of data, a lot of quantitative conversations, a lot of modeling conversations, but as we mentioned, we provide the role of bringing the model to staff to help work on looking at different portfolios. We bring our expected returns. There's usually a check to see what other organizations' expected returns look like for similarity or differences. And then we meet with your staff and model different portfolios that they're thinking about. We provide our 2 cents as well. And then the process moves to John thinking about any changes in the ranges that he wants to propose for the funds and then bringing that to you in the fall. So that's a quick view of kind of the roles all of us play in this particular process. And another good reminder is whenever we're in a market environment, it feels like it's going to last a long time. You know, this high inflationary environment may cause you to want to react and do something in the short term. And really, there is tremendous benefit to sticking with a long-term strategic asset allocation, especially if you have a long-term time frame. If you weren't a long-time investor, just to give you a few examples of how hard it has been to be a patient investor, if we look at the S&P 500 return in 2019, it was 31.5%. Bonus, terrific, made lots of progress on growth. The next year, 2020, even though we started off with the big rocky COVID correction early in the year still turned out to be a positive return of 18%. And in 2021, a return of almost 29%. And then last year, a loss of 18%. So it really is a rocky ride, and it can tempt a lot of investors to react when really studies have shown that sticking with a long-term plan is going to be accretive in the long term. So those are the footnotes to the conversations, or the reminders to the conversations, and then the roles we all play.
One thing I think might be important is Board of Investment, we're not voting on what we think the expected return is going to be. So if somebody asks you, well, what do you think it's going to happen? We don't have a position on that. The consultants may have or something, but we don't put that out that this is what our our predictions are. And that's to keep Dan out of trouble.
You got a hell of a lot more work to do than that.
I know, but you got to start somewhere.
Any questions? And thank you for the generosity of your time. We really appreciate
Well,
it.
thank you. That's a good start. And I think a lot of this will make a little more sense when she comes with the actual model.
Yes.
This is the background of that. So we're almost, go ahead.
I just got a quick question. How comfortable, I know it's the data that you have, but there's an awful lot been written lately about how bad the U.S. Bureau's labor numbers are. There's a lot of questions on the data. How much do you think that affects that?
It's something we look at, you know, unemployment, for example. And if you look at the interesting dynamic that who would have thought we would have been hit with a pandemic? And who would have thought that that caused a lot of people to drop out of the labor force? And, the big question is it permanent? Are they retiring early as a result? Can they afford to retire early? So one of the things that we certainly looked at when you're looking at inflationary factors and the health of the economy is that our unemployment is still at historically low levels, even though we know the participation rate has had those challenges, people just dropping out. But expect that as the Fed is going about their work, they've messaged that they're willing for the labor market to get more challenged, to have more unemployment as they put more and more constraints around the economy's growth. They're expecting that, you all saw the statistics, that for every worker, there was something like 1.7 jobs available for them. Crazy. Terrific market if you were looking to get a job, but very hard for employers that are competing for talent. But as we look at unemployment and the inflationary elements of it being that we are at such low levels of unemployment, we don't think that's going to persist. We think over time that will float upward, and almost by definition, of course, if we have a recession, then you could expect it to float over it. And remember what it was during the COVID crisis. It actually got up to something like 14% for a short period of time.
Yeah, if I could chime in on this, your question is quite spot on. There has been quite a lot of controversy about the degradation of a particular kind of data that the government and other governments acquire, and that's survey data. And it has to do with lots of biases and non-responsive elements creeping into the survey data. If the data that we have talked about today, there is no survey data in it whatsoever.
Yeah.
It is actual market valuations, things that were paid for stocks and bonds in history and currently, earnings that have been recorded. Now they can be squishy too,
Yes.
but they are as close to facts as they can have. So I think that while that concern that you raise is quite important with respect to creating government policy, it doesn't bear nearly as much, and in fact, hardly at all, on the kind of data that we use in this particular exercise for asset allocation. And I would also say to the chair's comment that you're not predicting a return. Your responsibility is to build a portfolio that is the best you can think of and the best that you can construct, given all the uncertainties and the information that you have. And then the market will determine what the returns actually are. I mean, Becky just gave you an example of wildly varying markets. What we have seen is that when we look back and we look at these assumptions and we say, what if we were to put another percent or a proportional amount on every single assumption, would it create a different asset allocation? And the answer is no. So it's the asset allocation that emerges that is the responsibility of the folks in this room. The return is going to be the interaction between that asset allocation and whatever the markets deliver to us and to John. So I'll stop there.
So maybe I'd add to that a little bit. When we're thinking about the asset allocation process in the fall, I mean, this is a great process. Lots of numbers here. We're looking at what RBK has done. We're looking at what other participants are telling us in the market. At the end of the day, and Becky addressed this right up front, it's less about being precise. We're always going to be wrong about our predictions of what any given asset class is going to do. But directionally, I think we tend to be right. In other words, we may disagree with RBK's assumptions on particular asset classes, but I would say most of the time, likely, we agree that, okay, private equity is probably going to be one of the higher performing asset classes over the long term. Public equity is going to outperform fixed income over the long term. And so that ultimately is the mindset that drives this process. And given our long-term nature, and a lot of the other board members here can attest to it, I don't remember a time when we've ever come to the board and said, well, we want to go from 28% domestic equity to 10% this year or something, and then back again. It's, hey, let's move it a percentage or two this direction or that because we see some value here. Jack will have a heart attack if I do that.
I did have a heart attack on one thing. I'm not recovered yet.
So just to give that context, this is a useful process. I think it's valuable that we go through it every year, but it's not the be all end all. Judgment is applied to all of the things that we do, obviously, and it's best efforts, I guess, if you will, at the end of the day, and what seems reasonable.
I'd call it a structured decision-making.
Okay, so we got a little break scheduled here. So we'll be back at 2:30 and see if we're awake still. Thank you, guys.
Thank you.
We'll go to, so I'm glad we're in progress. We'll go to tab 4, international equity. And so John, you're going to introduce anything, or I'll turn it over to you or your staff?
No, I'm going to turn it right over to Jason and Steve to talk about international equities.
Thank you, Mr. Chairman, members of the board. I'm on slide 2. At its most basic level, international equities asset class is investing in equity investments, publicly traded companies based outside the United States. So these are liquid stocks traded on exchanges around the world. And we have 2 broad categories that we use to think about how we access international equities. One would be actively managed portfolios, and the next would be indexed or passive. We use those terms interchangeably. So active and passive. And what that means is an active portfolio is looking to outperform a benchmark index, and a passive portfolio or passive strategy is looking to match the performance of the benchmark index. And those two, I want that to be clear. Moving to slide 3, shows the assets by even by asset class, with international equities being the 5th largest within the entire board of investments. It's the 3rd largest in the pension portfolio, which comprises about 16% of the pension assets. Slide 4 shows the ownership. Essentially, all of the international equities is located in the pension. There are small allocations in the state fund and the DC disability plan. You see the dollar value added, you see the long-term track record there. Any questions on this page? No questions. I will turn it over to Steve. He'll talk about the asset class policies and structure.
All right, ladies and gentlemen, pleasure to be with you here today. Our asset class benchmark for the international equities is what we call MSCI ACWI US IMI. Now, I realize that is a whole lot of abbreviations in one sentence, so very briefly, MSCI is just the name of the company that provides the benchmark that we use. All country means that it includes both developed and emerging markets, and investable market index indicates that it is essentially an all cap benchmark containing stocks from large to small cap. So that's as short as I can make it to explain what that actually means. As Jason mentioned, most of the international equities are located in the pension pool. So it has a greater number of restrictions. 10 to 20% of cap can be in cash. As Jason mentioned, it's about 16% right now. The small cap weight is limited to the benchmark weight plus 10%. It is currently a couple percent overweight. We do have a restriction on a minimum amount that can be in passive investments, which is a minimum of 42. It's currently about 51%. And as I mentioned, we do have both developed and emerging markets as a portion of this. The emerging markets portion is kept within a range of plus or minus 10% of the benchmark weight. It is currently sitting at about 1% underweight. State fund, which does have some international in it, really only has one restriction on it, which is It can't be more than 4%. It's currently about 3%. And DC Disability similarly has really only one significant restriction, which is equity international within 10 to 30% of overall assets, and it is currently sitting at about 25%. So any questions on that chart, Mark?
Back to you said a minimum percentage in the cap in passive?
That's correct.
40%?
42, yeah,
Okay.
and it's currently 51.
Okay.
So, yep. All right, I'm going to flip over to page 6 and talk a little bit about how our international equities are actually structured. We would consider them to be well diversified in terms of country, region, sector, and style. When we get to page 7 on the next page there, you'll be able to see kind of how that breaks down, but just as a verbal description, that's what we would characterize it as. As Jason mentioned, it's a mix of indexed and actively managed portfolios. And as I mentioned, we do have both large and small cap exposure. And because we manage those portfolios generally separately, we can control the allocation between large and small to an extent. Developed and emerging markets. So developed markets obviously are the big well-known names that you would probably think of, not the United States because this is international only, but the UK, most of the European countries, Japan, things of that nature. Emerging markets are those that are less developed and typically haven't been a part of the overall investment universe for quite as long, but they're still fairly safe investments at this point. They're not what we would call frontier markets, which are pretty far out there. That would be the bigger ones are China, Brazil, Russia used to be in that category until they decided to raise trouble with their neighbor and got booted out of the benchmark. So not anymore.
And India is?
India is in the emerging markets category. That's one of the larger ones as well. So because we use MSCI as our benchmark, we also use their country definition. So essentially whatever country they say is developed or emerging, we go along with that description. As I said, we do have an overall range at the asset class level of how much can be in EM, but it is primarily an outcome of the individual manager decisions. Now, typically the managers also have either a plus or minus 5 or a plus or minus 10, depending on the nature of their investments as to what their individual allocations can be in EM. And so that all rolls up to the asset class level. We do have EM index funds and ETFs such that we can feather that or tweak it a little bit. If we don't like where our overall exposure is, we can make that. But typically, because we're hiring our managers for their expertise and to make those sorts of decisions, we don't tinker with it too much. We do have the option, but we typically, for the most part, just let the managers do their thing.
That says plus or minus 10%?
At the overall level.
At the overall level,
Yep.
so 90% developed, 10% emerging markets?
No, so I'm gonna use an approximate number. So the benchmark weight in emerging markets is somewhere between 25 and 30%. So I'm gonna say 25.
So we could be 35 to 50.
That's correct.
Okay.
That's correct. And as a practical matter, at the moment, we're about 1% underweight. So it stays pretty close. And the only other thing I would say is that cash levels are limited by policy. If you include both cash, a minimal amount of cash that we hold in STIF at the asset class level, and any individual cash or cash that an individual manager may hold in their portfolio, when you roll that all up, it's still less than 1%. So we aim for fully invested portfolios, and that's what we've got.
Just to go back on the topic of emerging markets. In the investment universe, there's not a standard classification for what is emerging markets and what isn't. In this case, for this asset class, MSCI is determining which countries are emerging markets, which That will be different from, say, in our non-core fixed income, we have an emerging market debt strategy. That what they consider emerging markets is different, will be quite a bit different than what we have.
So you
It's determined by the benchmark provider, which is JP Morgan. So
you have different definitions of emerging markets depending on the asset class, I hear.
Any other questions on structure bullet points on page 6? On page 7, again, this is basically just more or less a graphical description of what we just talked about. There you can see how we're sitting in terms of emerging markets, how we're sitting in terms of active versus passive. We're a little bit overweight small cap, not a lot, and you can see our sector breakdown versus the benchmark is, for the most part, pretty close. We are somewhat underweight real estate, somewhat over financials, and everything else is, within striking distance of the benchmark weight. So we, again, hire our managers for their stock picking expertise more than for their sector expertise, and so we wouldn't expect there to be mammoth differences over time in our sector exposure versus the benchmark. And
These are all 1231.
yes, everything in here is as of 12/31. Apologies for that. And then on page 8, this is just kind of a breakdown of what the actual country exposure looks like. Again, you can see Japan, UK, Canada, France are really the big dogs in terms of developed markets. And then it gets a little bit smaller, and then it gets so small that some of them are 1% or less, and they would have made too messy of a chart, so they all just went into other developed. And then we just have a summary of the emerging market slide, which, as I said, is somewhere between 25 and 30%. It turns out to be about 26%, and then that 1% cash weight that we talked about.
You have a breakdown of the countries inside that, just maybe the top 2 or 3 or 5?
Within emerging markets?
Yeah.
I do. In fact, I brought that with me because I thought that might come up.
I thought you might ask.
Top countries within emerging are China, Taiwan, India, and South Korea. And Brazil after that, and then it gets small.
Okay. And then percentages?
China is about 9%. So that's 9% of the overall, not 26 times 9. So you'd have 9 plus 4 for Taiwan, India 3, South Korea 3, and Brazil 2. So that leaves about 6 left over. Absolutely. So barring any further questions, I will hand it back to Jason.
on page 9, so I thought it'd be useful to do a little bit of comparison between international equities and domestic, given that most people have a little more familiarity with the US stock market. First, one of the big differences is the different sector exposures. And if you look to, I don't know if you can look on page 10 on the right side, you see what really stands out is the exposure in the US market to technology, which has grown over time and is more than twice the weight of tech in the international equity pool. Other differences would be there's a little bit more in financials and industrials in international than there is in the US. What that really means is that the US tends to have more of a growth tilt and international has a little bit more of a value and cyclical tilt. So when you're comparing one versus the other, international versus domestic, as we were talking beforehand, there are a lot of things below, a lot of layers below that you have to take into consideration.
Jason, I got a question on that. So on the financials, that's primarily in the developed markets?
No, it's not. I'd have to get the breakdown. I don't know. There significant amount of EM are in developed market financials.
In the financials, okay.
How do chip manufacturing, where does that fall into this?
Taiwan.
Which sector?
That would be in tech.
Tech. So that international includes chip manufacturing. That's pretty interesting.
Like Taiwan Semiconductor, which I think is the largest in the international benchmark, is included in that. So that's interesting. So it drops off kind of quickly after that.
Well, it would include chip manufacturing if if the company was domiciled in Taiwan as opposed to an Intel plant in Taiwan.
Yeah, that's one of the things too, we were speaking about we're going off the domicile of the company, which can be very different than what we might call the country of risk, or where that company generates its revenue. For instance, a UK company. If you're buying a UK company, are you buying a real UK company? Well, you're buying a company that has about 20% of its revenue in the UK. So you get quite a bit of difference in terms of the risk of that company, where its revenue is generated versus just where it's domiciled sometimes.
We looked at that chart too, and I was a little surprised. Even in the US, it's 60%. So 40% of the S&P 500 revenues come from overseas.
Another difference. Trend, that overseas trend in S&P, is that it's going up?
Definitely. Last time I looked was a few years ago, and it was 30%. And we talked about 20 years ago, it was probably 10.
Next would be the effect of currencies. This probably would be one of the number one on the list, that fluctuations in foreign currency valuations affect the returns of the asset class. So our returns are measured in US dollars. So if the dollar is strong, that means the foreign currency is relatively weaker, which is a drag on returns when measured in US dollar terms. And the other way around, if the dollar is weak, foreign currency is relatively more valuable. That is a boost to returns when measured in dollars. And as we talked about, the dollar has been on a long stretch of strengthening in terms of positioning. Like, is that likely to happen? Maybe not. But one of the things we can take into consideration overall when we're thinking about asset allocation and other decisions. Also, the international markets have a lower average market capitalization, so generally smaller companies on average, less concentration in a small number of stocks. For instance, the S&P 500, the top 10 make up about 27% of the total index, where with the ACWI ex-US, it's about 11%. So a huge difference there in terms of concentration. One other difference too is the way we access, or way we can access international markets. The main way would be through local shares, or ordinaries as we call them, where it's a German stock trading on a German exchange, or an Australian stock trading on an Australian exchange. We also have, in some companies, the opportunity to buy what they call ADRs, or American Depository Receipts. So these will be a certificate issued by a U.S. financial institution that represents one share of stock in that foreign company. And as it applies to what we do, why would they want to buy an ADR? There are certain countries that we do not have open for our managers to trade in, and they can access that market partly through an ADR in a company located. The biggest example is India. India has a crazy process for getting access to trade in Indian stocks. So our managers can invest in an Indian ADR of a company to get access to that company, as opposed to having to trade locally on an Indian exchange. And one difference too, I mentioned that at the top, that these are international equities are liquid, they trade on exchanges. ADRs typically trade over the counter, which means that our managers would be trading with a broker dealer as opposed to on an exchange for an ADR. Last difference, cash largely is foreign currency to facilitate buys and sells in those individual markets. So that is one other difference there. Any questions on this page? Page 10, I showed we talked about the difference in sector weights, characteristics. I just point out market cap, the weighted average market cap of the domestic pool is over 5 times that of the international pool. other characteristics, higher growth, lower dividend yield with domestic, higher valuations. That again points to US having more of a growth tilt and international having more of a value tilt to it. Move to page 11. So some of the ways the portfolios or vehicles that we have inside the asset class. First, index portfolios. Again, this is passive. They're trying to match the performance of an index. Our passive investments are all through commingled funds. That means we are invested with other investors in a particular fund. I think one of the primary benefit is that if we're trying to match the performance of an index, that the manager of the commingled fund itself will do the paperwork and the work it takes to open up those individual countries. So we can access essentially every country in the benchmark through a commingled fund, where the actively managed portfolios that I show down here below are all through separately managed accounts. So this is our separate fund. We have more control over the assets. We can have more control of the guidelines of the assets. Reporting frequency is one difference. For commingled funds, typically it's monthly in terms of reporting holdings. With separate account, it's daily. That's one benefit. Next would be a kind of a blend of methodologies. And to boil it down, so we have what would be considered fundamental managers, and we have a quant manager. The terms aren't real accurate, and I'll try to explain. A fundamental manager is what you might think of the typical stock picking team. They have a team of analysts working with a portfolio manager to make stock picks and construct portfolios. A quantitative manager would be one that uses a mathematical model to pick stocks, construct portfolios. But that mathematical model uses fundamental factors. It may use other factors too, but it's not that a quantitative manager does not use valuations or earnings growth. They do, but they put it all together in using a mathematical model to help that. The other difference between those two is our fundamental managers, if you want to call them that, typically more concentrated. They may have 70 to 90 stocks. Quantitative managers will have, I think we've got 500 in the large cap and 700. And so they're using all these factors to put together, making smaller bets over a larger number of stocks. I think the other term I've heard recently to try to more accurately call quantitative is quantamental. That because there are certain other types of strategies, like in hedge fund world, where quantitative means something completely different than what we're doing. And but just to reflect that, the quantitative manager, as we use them, they are using fundamental factors and picking stocks. It's just a different way of doing it than a traditional way that you might normally think of. Last, we have in the portfolio exchange traded funds, or ETFs. So an ETF is a basket of securities that tracks an index. That basket trades on an exchange just like a stock would, so we can trade in real time. I think at the end of last year, we had about 8% of the international equity portfolio in ETFs. And the reason we use those, we don't have a whole lot in them, but it facilitates liquidity. There may be times where John comes to me and says, hey, I want to raise some cash. Let's take some out of international equities. Maybe there's news or there's a Fed meeting or whatever coming up. Like, yeah, let's do it today. We can do that through the ETFs. We can trade today. With the index funds, there's a lag. So we will put a trade in. It will, there's a notification. So 2 days lag before they actually trade. So sometimes we're fine with that. Other times, like, yeah, let's go ahead and trade immediately to do that, to raise funds.
And those ETFs, what are the costs or their costs? Is it pretty low to use those?
I'll talk about that a little bit later. That's one of the changes we made in the last year, is to change our ETFs from higher cost to lower cost. a little bit different exposures. There's not quite the liquidity in the newer ones, but the cost is a lot lower, and it makes a difference. And we are not trading every day in ETFs, so we don't need massive amounts of liquidity. We do this fairly rarely. And so that was a benefit that allowed us to dramatically reduce costs. And you see it in the portfolio, even though it's only 8% of the total assets, the cost reduction was noticeable.
But Jack, are you talking trading costs or are you talking cost of owning that ETF?
More than trading is the total cost. I mean,
But I assume the other costs are.
Trading costs are pretty minimal.
You share them? You share commissions? Cheaper than it was 3 years ago. Going to page 12, just a breakdown of our indexed or passive portfolios versus our actively managed, including the quantitative and fundamental. You see our indexed portfolios with BlackRock, as well as the ETFs listed there too. Page 13 breaks it down by style. So if you think of growth and value, growth would typically be a company with higher earnings per share growth, higher sales growth, probably higher price to earnings ratio, higher price to book ratio. Value would be lower earnings growth, maybe more cyclical companies, lower price to book, lower PE ratios. And core is kind of in the middle. But the core index will hold some of those stocks that are in the value index and some of the ones that are in the growth index. It's just a broader slice of the investment universe. And it shows our value, core, and growth managers. Any questions here? So I'll turn it over to Steve to discuss our due diligence process and research.
absolutely. So we don't come to own the active managers that we do by chance or by guess. We do quite a bit of work on it. We do, as I guess let me talk about the maybe about the selection process a little bit before I talk about the ongoing part. We do have a lot of tools that we have at our disposal. We mentioned here eVestment, which Jason is going to do a demo on in a little bit. We mentioned FactSet here that I'm going to do a demo on in a little bit. So they are ways to start with a large universe of managers and funnel it down into something that's more manageable. And so we typically will set some minimum parameters in terms of how long the company, the manager has been in existence, what their minimum level of assets are, things of that nature, because, you know, we view ourselves as a, I guess we'd like to say, a sophisticated institutional investor. And so, you know, we would like to interact with other sophisticated established entities rather than ones that have only been around for a couple of years. So that's, we use the tools at our disposal to kind of funnel that down. Then it's, I guess I'd say, a matter of more fundamental research on our part. So rather than doing fundamental research on a stock, we're doing fundamental research on managers in terms of phone interviews or even in-person interviews with the management and staff of these managers to you know, understand their process. How do they go about making investments? How do they go about hiring and firing staff when that becomes necessary? You know, performance is a part of it, but as I mentioned in a little bit here, it's never the only factor of it. Obviously, we don't want to, especially with a new manager, we don't want to hire somebody that is persistently behind the benchmark. But you know, these are all things that kind of go into the pot that we think about when we're making a decision on these. So we'll narrow this down to typically maybe 3 or 4 finalists that we will invite to come here and make a presentation to us in person. Typically, you know, we're in most cases, only looking to actually make one hire in any given space. That varies. And the managers that we don't hire, we still want to keep an eye on them. So we talk about here about the development of bench managers of interest. When we've gone to all the work to say, you know, we like this manager, they're just not the one that we're going to hire, but we would be comfortable with them as a substitute. For example, if one of our existing managers ran into trouble and we needed to get rid of them in a hurry, we would have a place to go without having to do a full-on search every time we necessarily want to hire a manager. So that's kind of the hiring process that we go through. In terms of ongoing research, we have a detailed quarterly review process that we don't just rely on our managers to tell us what they, you know, what they want us to hear, because, you know, obviously bias being what it is, you're gonna probably promote your good points and kind of downplay your bad points. So with FactSet that I'm going to demo here in a minute, we actually get from the custodian, we actually get those daily and monthly holdings fed directly into the system, so we can see at any given point in time what that manager actually holds, and we can run attribution by size, by country, by sector, by however it is that we want to do that to figure out you know, what it is that drove their performance during a quarter or a trailing year. So that when we do a conference call with them, which we do with each one of our managers every quarter, we come to them with questions that we've already kind of broken down the portfolio. And so we'll ask them, you know, why when you said you were going to probably reduce your weight in this country, did you end up increasing it instead? You know, why did this one particular stock outperform or underperform by such a large amount? You know, we are ready to go at the time of these calls with questions to ask them. We have a manager scorecard where we track, I think, like 11 different data points on each manager in terms of, you know, company ownership, portfolio management, team stability, performance, client service, a whole number of things like that we track on a quarterly basis. So we kind of have a pattern over time that we can follow to see, you know, are they holding up? Are they declining in some areas? You know, or are they getting to the point where maybe we would be better off with a different manager? And as I said, you know, performance is only one factor in that. Some asset owners have an automatic 3-year termination that, you know, if you underperform for 3 years running, you're automatically booted from the portfolio. We don't have that kind of a thing. For us, it is all very much, I would say, an organic process rather than a strictly rules-based one in terms of keeping track of these managers. We also, when I say that performance isn't the only thing, that's for good or for bad. We don't chase, we aren't trying to chase short-term performance because we're long-term investors. We have a 30-year amortization period. So the fact that a manager does exceptionally well or even poorly over a year or like I said, even a 3-year period is not necessarily the only thing that we're looking at, as long as we view them as sticking to their process. You know, we understand that there's periods of time that any given process is not going to be favored by the market. So we would rather have managers stick to their knitting, even if that results in short-term underperformance, rather than them trying to chase whatever they think is working right now, because that tends to be in our view, not a winning strategy over time. We do on-site, you know, we have them come visit us. We also go visit them. Typically, if there are a number of managers in one area, West Coast, Boston, New York, whatever it is, we'll try to, you know, meet with several of them at a time. But it is good to, you know, see where they actually, you know, what their systems look like. You know, what does their trading floor look like? You know, how is the team seated? You know, we've interviewed some interesting folks where the PM, when he would have meetings with his staff, actually didn't want to see him eye to eye because he was afraid that somebody was gonna accidentally give away body language or things like that, or they didn't. He wanted to hear what they actually had to say, not what he thought they wanted him to say, and things like that. So I mean, you see some very interesting setups, but in order to get a real flavor for that, at some point you need to actually be there on site and see how it goes. So, and then RVK involvement, I should mention that as well. Jason and I typically work with a different group of folks from RVK than you normally hear from directly, which is their investment research staff. And they have their own views on a lot more managers than we do, because I mean, that's what, kind of what their, the main thing that their investment research staff does is to meet with managers pretty much all the time either. And I think they do kind of the same thing. Sometimes you have folks come visit you, sometimes your staff goes to visit them. And so they're able to develop views on a much larger group of managers. And so our view is, if I can frame it this way, we don't take marching orders from RVK, if I can phrase it that way, in terms of who we hire, but we do very much go to them and say, we'd like to, see your list of your top managers in whatever space we're looking to hire someone, so that we make sure that we interact with them and see, if we think that they would fit what we're looking for. If we have a manager that, that we've come across that we're interested in by whatever means we came across, and I always go to their investment staff and say, what do you know about this manager? Are there any red flags that we should know about that we, maybe we weren't aware of because we haven't been covering them for as long? So again, it's much more of an organic process than just saying, okay, RVK, whoever you like best, we're going to hire. We certainly take their input. Sometimes we hire folks that are on, that were on the list they gave us, and sometimes we may hire a manager that was on our list to begin with, and that they had subsequently met with and said, yeah, we think they're okay. So it's, like I say, it's much more of an organic process, but we view it as an important part of the process. So that's probably fairly verbose, but any questions that anybody would have on diligence research before I give you a FactSet demo?
Just to add on that point about the interaction with RVK, that's something I've tried to enhance or develop, or at least over the last year. When the directors went to Portland to discuss asset allocation, I stuck around for a day and met with all the leaders of the different research management teams. And I know, at least in one case, more recently, there was, not in this asset class, but it was a manager that we were looking at that they knew of, but didn't know them intimately. Well, they did more research, they did their on-site. We compared notes, that was very helpful. As it pertains to this asset class, I'm not going into too many details. Talking with Britt at RVK, like, Britt, here's what I think about this. Am I crazy? And what he said was, no, I'm not crazy. That we had very, very similar views on this particular issue. And it's good to hear that. That's not necessarily that I need somebody to tell me I'm not crazy, but just that, why am I not crazy? And what he said confirmed what I was thinking. So I think hopefully we get to do that again this August, but I think it's been helpful. And it's interesting to hear other opinions too.
Okay, I am going to attempt to share my screen here, which I think I'm able to do, and that will. If I share this specifically, that'll be the best thing. Ah, there it is. Let's see if I can minimize this. Okay, so what we have here is FactSet. So it is a very in-depth, very broad investment analytics program. Now, you can use it for a lot of things. You can use it for tracking markets. You can use it for, if you are a manager that has, if we were doing our own internal stock research, you can use it for that. But what we use it for is in the under the auspices of an asset owner. So we have, we are the ultimate beneficial owner of the stocks. We just happen to be hiring other managers to run them on our behalf. But as I said, for any given portfolio, we get those holdings fed in here daily and can run our own analytics. Now, just for consistency, everything that we're showing you today is as of 12:30, and we have chosen to use the Acadian small cap portfolio that we have. Now, we have Acadian for both a large cap and a small cap international. This is the small cap one. It is more of a core type portfolio. It has a little bit of a value flavor to it because of how the manager's model is structured and what inputs they feed into it. But effectively, it's a core style manager, and so it's benchmarked against MSCI ACWI ex-US small cap. So that's the small cap portion of our standard benchmark. So what we're looking at here is a breakdown by sector of their performance in the quarter ended 12/31. And as you can see, we have the sectors here are again as defined by the benchmark provider because they're our benchmark provider, and so we just go with them in terms of country and sector definitions. I'm going to scroll down a little bit here, maybe. There we go. So you can see there's 11 sectors plus cash that any given portfolio holds. So for that quarter, they outperformed by approximately 46 basis points. And if we scroll up here, we can see that real estate was a large portion of that, actually accounted for more than the positive total. Whereas there was a partial offset, for example, here by utilities. And we break that down into allocation, which basically is a function of how much overweight or underweight are they versus the sector, the benchmark sector weight, and then selection is, how did they do with the actual stocks that they picked? And they may pick things that are in the benchmark, they may pick things that are outside of the benchmark. But in the long run, we would expect a larger portion of a manager's performance to come from selection than allocation. And you can see here that is the case, plus 69 basis points from selection and a minus 23 from allocation, giving us that positive 46. So this is by sector, and if we pick, I'm going to pick real estate just because that was the one that was the best. We can drill down into that and see the different industries within that, and we can see how the individual stocks within that did. There's one in particular here. I'm gonna guess based on the name that that's probably a Turkish stock, but I'm not gonna try to pronounce it because. Give
it a shot. Never mind.
So we can drill down into that. So as I said, I actually brought in my write-up that I did with these managers in advance of the call to figure out what kind of questions I wanted to ask, and I'm like so this is by sector. We can also do it by country, which as we mentioned before, these definitions are as provided by the index provider. So here you can see all the countries that are identified as being developed countries. You will see a United States here, and that's probably an ADR. Sometimes, when we talk about ADRs, because they typically are created and maintained by domestic banks, they tend to show up under United States, so I have to make some slight manual adjustments for that, like this Make My Trip, this is an Indian country or company, for example, when we mentioned that we typically have to use ADRs for India because of not having direct access to the country because they want passport numbers and things like that. That shows up there. Brazil, emerging countries down here, all the big ones that we talked about. Greece at one time was a developed market, but they had some trouble and got kicked back down into emerging markets. Some of these Middle Eastern countries, Kuwait, Qatar, things like that, those have relatively recently, in the past couple of years, been elevated from what we call frontier market status, which, as I mentioned, kind of in passing, is an even lower level than emerging markets, and typically we wouldn't have too much there. Those are some countries where Kuwait is kind of the exception. We're working on getting that open for all of our managers, but Qatar here, Saudi Arabia, those are places where the requirements for opening them are still too onerous for us, and so we've chosen not to do that. But they are relatively small parts of the index here, so as a portion of the benchmark, less than 1%. So the fact that the manager is not able to fully invest in all countries, hopefully, is not too big of a deal. We have one here that shows as a frontier market for Cyprus. I think this is kind of a lot of Russian companies actually do business in Cyprus for freight forwarding and things of that nature. So this actually is a legacy position that possibly we haven't been able to get out of because of the Russian markets being closed. But as you can see, it's de minimis weight and de minimis impact on performance. We can break it down by market cap. So we can see here that relatively smaller names within the portfolio, quintiles 3, 4, and 5, which it's already a small cap bench portfolio, but even within that, it tilts a little bit small. So the smaller companies that it holds tend to do better than the larger ones, which for Acadian is not terribly surprising. We can also look at these same breakdowns by year, or frankly, any other time period I would choose. Stock attribution, here we can see now come on, I saved this and it didn't do that to me, so I apologize that it did that. I'm gonna choose this one instead. So here we can see the best performers in terms of their absolute performance. Or actually, no, I think this is in terms of, so that one would be absolute performance and this one would be relative performance. Yeah, that's right. So you can see here, there's one stock here in particular that did quite well. I'm sure we asked them about that at the time. And then you get the same thing on the bottom. I just have it set to show the top and bottom 20 of each case, and being as this portfolio holds a lot of names, that's plenty. You don't need to, especially with a quantitative model-driven one, you don't need to ask about 746 individual names. You'll be there all day. But the biggest ones that were driving the majority of performance are the kind of things we want to ask about. We can find portfolio characteristics. So this is kind of similar to what's on page. Let's see what page that was. Page 10 of the presentation materials. In fact, I used this same program to generate that chart. As a matter of fact, I just did it on the entire asset class instead of an individual manager. But here you can see it's better yielding than the benchmark. It has a little bit weaker growth than the benchmark. It's cheaper on price to book. It's cheaper on price to cash flow. It's cheaper on PE, which again, for this portfolio, those are all the kind of things we would expect. If all of a sudden it was trading a significant premium to the benchmark, that's the kind of thing that we would spot right away and go to the manager and say, hey, what's going on here? So again, we use this to ensure that in our estimation, they're staying on track with the style of performance that we would expect from them. So this is basically the holdings-based side of it. If we want to do calculations based on returns, we can do that as well. This portfolio, unfortunately, we've only had for about a year, so there's not a lot of historical data to show you, and this one's probably not the best example for that. I can show you multi-period performance. So we can see what they did for the month, what they did for the quarter, and as we have them for longer time periods, these will start filling out as well, whereas right now they only show the benchmark performance. But you can see again for the quarter, there's that outperformance that we talked about, 53 versus 31. So it's the attribution by holdings is approximate. The attribution by returns is pretty much spot on. So just several different ways that we can look at things and make sure that they're doing what we think that they ought to be doing based on our decisions when we hired them. And as I said, hopefully determine intelligent questions to ask them when we're ready to do a quarterly review or anything else that we need to talk to them about. So unless anybody wants to see anything in particular, I will pass it off to Jason.
Yeah, we use FactSet for a lot of things. The primary use is to prepare for a quarterly call. And generally speaking, we have the returns. Okay, what worked, what didn't? What are the drivers of returns? What do they own? And what has that changed over time? And so those help us get a little better picture of what's going on in the portfolio and to come up with questions to ask managers. Other times too, and on the page it says, we're doing due diligence and ongoing research. I'm not big on semantics, but this was something I think was very important because a lot of times we refer to manager monitoring. We're not monitoring. We are doing ongoing research on managers. We are always looking to understand more about their process. Things that managers are always changing, and our job is to understand what is changing, whether it's people or process. And so those are the things that I think, there are other cases that we look for, like on the Acadian, the other portfolio we have. They typically have a large overweight to small cap stocks. We think, well, how much of a driver of their overall outperformance has come from that? It's like, well, it's not coming from just having an overweight to small cap stocks. It's they are picking stocks that work. And so these things help us understand what a manager really does. But if I can share, so eVestment is a tool that we use relatively less than FactSet. It is a database of manager information. It is essentially the gold standard in the industry. Lots of manager information, lots of things you can do with it. The two main things we use it for that I'll discuss briefly. Screening, that would be if we're doing a search for a manager or if we just want to look at the landscape in a particular area of the asset class, you can screen. And you can see here, we can use firm information, product information, that would be the actual strategy, and come up with these parameters that will give us information. And I just ran a quick one. If I can switch over. So it's here's what a very simple screen might look like. Manager name, product name, looking at assets. How much an AUM does the firm have? What about in the product? What about how much of their assets come from institutional investors? We're not looking for a manager that has all their assets coming from retail managers. They wouldn't be set up to accommodate an institutional investor like us.
How do you analyze how accurate this information is?
Usually I'll check like a return, asset information is harder because they self-report. Returns, there's sometimes you can look, say it's a manager that we're doing research on that we haven't prospect, for instance. Their book, what they show in their presentation materials versus what is in here. It does occur sometimes there are errors. One of our old domestic managers, I was doing a write-up after a quarterly call and looked at the returns or the peer rankings, like, this is wrong. Like, I just know this is wrong. And so there is a handy button I can use in eVestment to say, hey, follow up on this. Or it'll send an anonymous message to the manager like, hey, update this information. This is wrong. So that's a nice feature of it. But and two, we want a certain amount of assets in the product. You know, they committed to this product, that they would be doing this long-term. Returns data, just pure trailing returns. Tracking error, which is kind of a measure of how different the returns of the portfolio are from the benchmark. Sharpe ratio is just a simple risk-adjusted metric. Upside, downside capture, how much, you know, when the market goes up, how much is the portfolio going up relative, or market goes down, how much is the manager, the portfolio's returns going down. This is very simple. There are hundreds of parameters you can put into a screen, but this just shows the value of, like I said, it can be something we typically use for prospects, but also in this case, this is the international small cap universe. And to get a lay of the landscape, to look and see, okay, well, what else is going on in that area of the market? And going back to, another thing we like to use eVestment for, move this stuff out of the way to access it. Is for peer analysis. This would be peer rankings, and we can do this on a number of different metrics, either absolute returns or calendar returns or different portfolio statistics. In this case, this shows the trailing returns and how that portfolio compares to peers. Obviously, we're looking at, we may have a portfolio that outperformed, but it could be in the peer universe that they really lagged, that others were outperforming more. What it typically will tell us is, as you see the rankings or the trailing returns change, is just understanding more about their process. There will be times typically where a portfolio or a strategy is out of favor. Okay, how did they do relative to peers? Or you're looking to say, wow, they really did much better. Why? Well, their strategy was really in favor during that period. Okay, that explains that.
How do you not get overwhelmed by all this data and can't come to a conclusion?
Well, I think the way we do it, there is a lot of stuff out there, is to focus on the things that we think matter. And that would be the micro, FactSet we typically use for like micro research, digging into the portfolio. And attribution, you know, understanding the drivers of returns. Sometimes it has its limits. It can't get too hung up in all the details, but it gives us a picture of what they're doing. And in terms of eVestment, I use it for, you know, usually for specific things. There are a lot of other things we could do with it, but if I'm looking at, after we've had a call, I'm doing a write-up, I'm looking to say, okay, how did they do relative to peers, and kind of track that and can understand that. But I think it's, yeah, you can get buried in data, but we try to focus on what we think matter, things that help us better understand as opposed to just, I mean, it might be fun to just kind of play around with numbers and play around with charts and everything all day, but we don't have time for that. And I don't think it's terribly helpful in understanding a particular manager. Any questions about either FactSet or eVestment? This is something we've had for, back in the old days, we did not have this, and we've had it for 6 years or so. I think it's very valuable. I think it's helpful. RBK uses it, and sometimes we'll ask, hey, you send us a manager and they're giving us eVestment data.
Is there any tools that are out there that we aren't using now that you would like to have?
Not that I know of. I'm not too up to speed on all the different other things we could use. FactSet and eVestment are the two basic things. And, if there were something, it would have a cost to it, and it'd have to be, okay, does that eat up more budget, or does it replace something? And again, replace either eVestment or FactSet. So I think the marginal benefit of something like another system would be limited, or the marginal benefit would be cost prohibitive. And we have to keep that in mind too.
Jason's got a Bloomberg on his desk too for the ETF trades and things like that. So there's a lot of.
How many Bloomberg do you have? Drew?
What was the question?
About 8, I think.
How many terminals?
We've got 8 Bloomberg terminals. So fixed income team, Jason, me, and then ops and risk management have got. There.
Okay. So we'll move on to page 15 in the slide deck. Some of the things we've been working on recently and are currently working on. First was what I call a portfolio restructuring. I'm alluding to it a little bit, but part of that came with changing our ETFs to lower cost ETFs. Again, a little bit different exposures, but not hugely different. And but the benefit of significant cost savings. And two, with more recently, was the termination of two international small cap managers. What we try to have is meaningful allocations to managers. And a rule of thumb, maybe we want 1% of the total pension assets in a particular manager, which would be 125, 150 million, depending on the time. In the two we terminated, I don't know if we had a total of 100, a total of 1% between the two. And as we looked at it, like we could keep that, but we looked at the benefit would be, one is better fee efficiency. So we can, typically a manager's fee schedule will have breakpoints that the larger amounts of assets with manager are charged a much lower fee. So having more assets with other managers, number one, be put into lower fee strategies to begin with, but two, to take advantage of those breakpoints of having larger assets with a particular manager. Two, I think the prospects we had or the opportunities we had were better elsewhere in our portfolio. And that was another reason to make that change. I think too, as we were doing it, to be conscious of, are we changing the risk return profile of the portfolio? And we've done work with third parties to provide them our data, our holdings, to run analytics. Some of our existing managers that have large organizations that can do this for us, to look at like, okay, we're taking more of a style bet that we don't know about, or a market cap bet, either up or a large cap or small cap. And the answer was like, no, we haven't changed really the risk profile. I think, hopefully, I think in going to what we think are better opportunities, that we might actually improve the return profile of the portfolio. But that was one of the big things we've been working on, at least over the last few months. The second would be, we worked this year on dealing with our managers to get management fee reductions. And I'm happy to announce that we have completed that. That'll end up about a little over $2 million annually in management fee savings, which is about 10 basis points reduction in terms of the overall blended fee of the portfolio, which is a big change. Some of that came from not just our discussion with the existing managers, but I mentioned the swapping to the lower cost ETFs. And those will be mostly in place April 1st. They took effect. Some will be retroactive actually to January 1st. So we'll get that benefit as well. The last would be something that we are currently considering and looking at in terms of positioning. As Steve mentioned, we're about 50-50 split between active and passive. And we've looked and thought, okay, just given kind of elements in the market and what we think is like, we've looked at if we increased our exposure to active managers, one, what would be the impact on the portfolio? Two, what would be the fee impact, exposure impact changes maybe. But two, as well, as we're looking at the overall exposure, what benefit that might have, and to the mechanics. Okay, if we wanted to do this, how do we then do it? And that's something we've been working on currently. And so that's, I think that's something that we will likely do sometime over the next few months, is to look at increasing our active exposure to active management. And part of the discussion too is, okay, then by how much? And that, been working with the numbers, and we've talked with John about that as well.
So using existing managers or selecting some new managers?
Existing managers. So part of that is mapping out, okay, how do we want to allocate that? Where do we take it from? What's the fee impact? Where is the best fee efficiency that we can get within the portfolio? There are a number of different aspects that we're considering, and how much too. What will be the impact of increasing by 5% or 10% or whatever? Last, page 16, I'll not go through the summary. You've already heard about it. Any questions you may have? But just to emphasize that you understand a little bit of our process, our commitment to ongoing research and understanding managers, and how we think about the asset class, as well as what we're getting. When we invest in international equities, what are we getting that's benefits the portfolio? And kind of, and two of the projects, what we've been working on recently, some of the achievements we've had in getting fee reductions, which I think is I'm proud of. And any other questions, I'd be glad to answer them.
Well, good job. That was informative, and thank you. Especially for the new board members. These guys, they didn't say it right now, but they are always available if you have questions. That they'd be happy to walk you through something or make sure the comfort level is there. And I think, at least I personally do have a good comfort level with all those we're doing. So with that, John, I've got a special request here. We go to recap of staff. Can you prepare a couple page lists for Dan? I don't care what you do.
Just anything?
Anything,
Just some work
but
for him.
see if we can't get some work out of them.
Sure.
Is there any, but seriously, is there anything that anybody needs?
You're asking for a recap of staff.
Well, I'll let John decide what assignments he'd like
Put in,
what to put in.
Cleaning the bathrooms has got to be.
That's what I had in mind.
Okay, there we go.
Mark, you had
So
something?
next meeting is May 24th, 25th. And I'm looking at the list here and the appendix. So we got state government customer relations. I suppose you're gonna invite state government.
We are not going to do that again. I know we have in the past, but it hasn't been particularly successful, so we will address that in a different format. But we'll certainly cover it, but we're not gonna have everybody show up for the chicken lunch that we've done in the past. It don't seem to get a lot of participation.
I just want to know how much I had to dress up.
Okay. Good. Anything else? Well, with the storm coming, maybe we can all beat the storm on the road, those of us that gotta drive, so. Have a good flight, and
Thank you.
thank you for coming. Thank you all. Meeting's adjourned.
Thank you.